all of us have an edge. All of our life stories are unique insofar as they can give us something we can bring to the market that almost no one else has. There's this concept when it comes to careers of hybridization, where you take two industries and you bring them together and you make yourself unique unto that.
What would you say has been the biggest weakness of your strategy, of you trading as a person up until that 10th year?
The biggest thing that held me back was probably self-doubt. Our intuition is the byproduct of the analysis performed by our subconscious.
How did you get over that self-doubt?
I'm gonna go ahead and share my screen now.
Wow, this number really blows my mind. Over 75% of you who watch the show regularly are not subscribed. If you enjoy the show and want to support us, the easiest and also free way is just to hit that subscribe button. This will help us find new and better guests, and I promise you to continue to work at making this show better and bringing you more value. Welcome back, everybody, to Be the Trader. Today is going to be a fantastic day. I have my man John Netto here, who is from the book Unknown Market Wizards by Jack Schwager. He has been trading for over 25 years, and he's going to be dropping a lot of wisdom today. And we're going to be diving deep into his story, then talking about how he trades, his methodology, and maybe share a couple of examples. So, John, welcome to the show, brother.
It's good to be here, Alex.
It's great to have you, man. So let's get this party started. First off, for those who don't know, you're also a veteran, so I really appreciate your service. And I've told you this behind camera, but I want everyone to know you're also, serving our country, so I appreciate that. And then on top of that, let's get started with, how did you even find this game? Like, what got you here?
Wow. So I, in high school, I always had a penchant for taking on risk, even junior high, elementary school. And I placed my first sports bet at the age of 8. And I just always had this appreciative understanding for risk. And, I didn't win my first sports bet, but it wasn't the Dallas Cowboys, and probably explains partially why I'm a Dallas Cowboy fan. But then literally I saw the movie Wall Street. And I think that if you told Oliver Stone, the director of that movie, the effect it would have on a generation, I think his intent was to show the greed and avarice that existed, in New York and throughout the 1980s. And what it did was actually turned a generation of kids and teenagers into people who wanted to work on Wall Street. And I was definitely one of those. I was lured by the adrenaline, the seduction, the challenge, the intrigue, the money. At the age of 12, I was it came out in 1987. I was 12. I was I want to be a trader. That's it. Dunzo. I want to work on Wall Street. This is where the action is. And I started, even at the age of 12, 13, I ordered the Wall Street Journal, and then what was Investors Daily back then. And I was reading that throughout high school and understanding. I think I read the Wall Street Journal had a book on options back then as well, that they gave you as part of a free subscription. And this is even before the internet. So I was definitely had an interest in my high school economics course. I was sharing, articles from the Wall Street Journal but my interests in high school really, were providing liquidity for those wishing to prognosticate on the outcome of sporting events. Okay. So I was a liquidity provider for people betting on sports. All right. And I was following the markets. And that was not conducive for a high GPA, but it was conducive for some great stories 30 years later and some real experiential learning. And that experiential learning, did not translate immediately to college, but it did segue a path to the United States Marine Corps, where we had to pick up a few more skills and traits.
It's interesting. You said you placed your first bet at 8 years old. What was that bet, by the way? What do you mean you placed your first bet?
I bet with a classmate on the Cowboys 49ers game. And I bet on the Cowboys and the 49ers won. This is right at the end of the Cowboy dynasty of the late 70s. And I grew up in the San Francisco Bay Area, where everyone was a Niners fan. And obviously that's a golden age of 49er football. Joe Montana, Jerry Rice, all those great, Dwight Clark, those great players. And I was in first, second grade as the Cowboys sort of late 70s dynasty was falling and the Niners 80s dynasty was emerging. And, so I had some very lonely Sundays in elementary and junior high and even early high school before the Cowboys and Troy Aikman and Emmitt Smith and Michael Irvin kind of turned all that around and they would become the team of the 90s. So it was feast to famine to feast again, as a Cowboys fan growing up as a kid.
What's interesting too, though, is you already had this kind of drive in you. You started your own, I don't know how to say it the way you said it with the intellectual words that you used, but a bookie. Yeah, a bookie. Yeah, you did that. And then you joined the Marines. When did you start physically taking trades? Like, I'm curious when that started happening. I want to take a couple of seconds to say thank you to our sponsor, Cobra Trading. Cobra Trading is the go-to broker for short sellers. And I'm not the only one saying this. In fact, Benzinga awarded Cobra Trading as the go-to broker for short selling. And Forbes Advisor did an exhaustive research on day trading brokers. And Cobra Trading was the only broker awarded in 2 categories, one of them being customer service. They have a heavy focus on direct market access order routing, so you have the fastest execution. They have some of the best locate prices and availability. Look, I've experienced many different brokers, and it's why I choose to use them every single day, and I'm proud to have them as our sponsor. Sign up now by using the link below, and Cobra Trading will give you 100 days of free commission, 3 months of free software, and 33% off commission for life. Now let's get back to the show.
So my father, just incidentally, my father would let me do investments, and I'd place a couple stock trades and whatnot, or investments or whatever, but then I wanted to sell it 3 days later, and that was anathema to him. He was like, "What? No, 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 you're investing, son." I'm like, "No, Dad, but it's up 0.75%." And I found this $6 a trade commission broker, this like 1989 or whatever. Let's say, no, 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 son, you're misunderstanding this, okay? But in terms of physically making trades, this happened my third year in the Marines when I was working at the U.S. Embassy in Tokyo, Japan. I was on a special security duty called Marine Security Guard duty. And I got assigned because I learned to speak Japanese my first 2 years on a different assignment in Iwakuni, Marine Corps Air Station Iwakuni, Japan, which is in the southwest part of the main island of Honshu. And I took and I was working in aviation support, specifically in the weather department, providing observations to F-18 and Harrier pilots. So it was a little more of a less gritty job in the Marines when you think about that when you're in aviation support. But that's what I was doing. Went on a couple of deployments to Korea and Thailand, but it's through that time that I began to get some savings. And then in my third or fourth year in the Marines, when I was stationed in Tokyo, I started placing trades on E-Trade. I opened up an E-Trade account. This is now 98, 99 time frame, and started to get more into it. Yeah.
Were you studying the entire time from like 87 till 99 about like when you got the Wall Street Journal, Forex, options trading workbook and all that? Were you like studying while you were in the Marine Corps and then started trading with E-Trade, or how was that process?
Yeah. Ooh, we're going back. You're testing my memory here. It. I was definitely studying throughout high school. I'd even gone so far as to take the Golden State Economics exam and score in the top 1%, all while rocking a 2.2 GPA. You know what I mean? So there was a disconnect between what my cumulative GPA was from high school and then these one-off sort of idiosyncratic outlier academic achievements that I guess it is what it is. But my interest in love continued for that. I'd say, as a practical matter, the operational constraints of running a bookie operation in high school probably meant more of my attention because my immediate risk management pertained around if the Browns or 49ers were going to cover the spread that night. And so the more immediate need of managing that risk, um, predominated against versus the other stuff. But yeah, that's it grew, like it's something that grows on you. Like you experience it both sort of viscerally and then intellectually. And that's something that I continued to follow. The first years in the Marines was a little bit tougher because when you're in boot camp, you're not reading the Wall Street Journal every day. I can tell you that. Or when you're in Marine combat training, which is the follow up to boot camp, or at least it was back then. And then you're in your trade school. That's a little bit easier, but still not really practical. And then I'm stationed in Japan. So again, getting information, and you're on one TV channel back then in the mid '90s.
Mm.
So like I was connected to it, but it really wasn't practical until like 97, 98, 99. So I'd had a couple of down period there just because access wasn't then what it is now. When you're
Yeah.
stationed overseas, you're paying $1.25 a minute to call back home back then.
Shit.
The world's changed a lot.
Yeah. So you pick up your E-Trade account
Yeah,
in around 97. And
yeah.
so what I'm curious about is what was like the first year like for you when you opened that account? Like, was it like easy? Was it lucky?
Unstructured,
Was it?
completely unstructured. Yeah. No, I didn't understand. Like, it paid a lot of tuition, Alex. Paid a lot of tuition.
Yeah.
Put on trades. Didn't really know what I was doing. Thought I knew what I was doing. Probably cognitive dissonance was really yielding there because of what I because I scored so well on the high school Golden State economics exam, I'm completely equipped to successfully trade the markets. Like,
Yeah.
huh? Some of the stuff is so ridiculous when you think about it later on. Like, what was I thinking? But it's okay. It's all part of the tuition. And so I would say that, like, not what I would say, but I still benefited from the overall trend of the market because I own mutual funds. I was long exposure. So let's think now about what 98 meant. You had the long-term capital management sort of fiasco that happened. You had the Fed that come out and cut rates. But overall, between 98, 99, early 2000, a pretty rip-roaring bull market. All right. And so I was still profitable, but for all the wrong reasons, just wrong reasons. And then in early 2000, when the wipeout came, talking now March 2000, April 2000. God, I can still remember that. I mean, I lost back everything that I had made in the previous 2 years in like 2 weeks. Okay.
Ooh.
Um,
Yeah.
no, it's okay. It's like
Yeah.
this is the tuition. You don't become the
Yep. Yep. Yep.
Protean trader, and I mean without taking your lumps and losing money along the way, and writing these lessons. So like, and that would definitely not be the last time I would take some big hits. So let's be clear, okay?
Yeah. Yeah.
And so yeah, so that transformation turned me into a technical trader, and then what also helped me out a lot, really reshifted my structure was a book written by Joe DiNapoli called Trading with D Levels or Trading with Fibonacci Levels. And I referenced this in the Global Macro Edge. But DiNapoli actually provided a great structure and talked about using Fibonacci levels and the confluence around those and then incorporating overbought and oversold indicators, which he developed proprietarily. And that became part of his book, which I want to say was published in 2000, cost about $150, $150. But Joe did a really great job with that book. And that book had a huge impact on providing me more technical structure,
Yeah.
because and now I can say 25 years later that from thousands or tens of thousands of hours of trading, that those confluence levels actually represent an expansion of volatility. If we want to get a little more detailed, nuanced around maybe, and I didn't realize this then. It's like, well, if you have a choppy consolidated market, these fib confluence levels, where you take a 382 from one pivot point to another, combine it with a 618 from another one pivot, maybe a shorter pivot point to another. When these begin to match up, these are representative of expansions in volatility. And when the expansions of volatility, at least by implication, can represent or usually represent periods of price discovery. And so when there's this periods of price discovery, there's this emotionality, there's this ebb and flow to the markets, and that really resonated with me. And I couldn't maybe provide back then as an articulate reply or explanation, but now having seen it over the last quarter century, what was very intuitive back then, now I'd say is more concrete now as to why that those methods of identifying markets that are going through expansionary price discovery periods, trending price discovery periods, and then you're providing liquidity. As I talked about in my book, One Shot, One Kill Trading from 2004. I buy weakness in rising markets, I sell strength in falling markets, and I take profits at predetermined price points. Okay,
Mm.
and that still to this day is a linchpin. It's a bedrock of my trading strategy.
You know, you also mentioned just now too, though, the idea of when you kind of took a big hit in 2001, 2000, I believe it was
Yeah,
2000.
yeah,
That
both actually.
that kind of
Yes.
both okay because it kind of changed you to be more
Yeah,
technical. So at first, what were
yeah.
you? Were you more just fundamental? Were you just kind of like winging it? Like what do you mean?
Yeah, I mean, more fundamental. Oh, look at this company. They're in the news today. They're doing good. Let me buy them. Oh, the market's going higher. Oh, this is a good stock. It's down on the day. But I didn't have any sort of technical sophistication around that. All right, and I can look at
Hmm.
charts, but I still didn't understand. So, but I started using charts, like I said, late 99, 2000 ish. That was by no means. I think anyone who tells you to use charts, it's not like the day you start using charts that you become unassailable to like market drawdowns. No, like there's still lots of potential for loss. I mean, it's just a different way of appreciating that price action. And that's what
Yeah.
charting does. But still, it's a viable tool to this day. But it's just not the only tool. I think that there's multiple mediums to be a consistent long term trader that are important.
When did you feel like you became consistent, even if it was a little bit? Just curious, like when did that start to happen for you? When you like stop having those big drawdowns where you give back, a year or 2 years worth.
Honestly, like it took still a couple years after that, and then my progress like was stacked. Okay, like my progress from '01 to '03 definitely improved by leaps and bounds, but then had a big hit in 2003. Then 2004, 2005 made another improvement. But I would say, as I talked about in the GME, that my real ascension, this is just the truth, man, like didn't hit until 2011. Like, so
Okay.
you're talking a real 12-year time frame from where I went to win, lose, win, lose, win, 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 lose, win, win, lose, lose, to I haven't had a losing year since 2009. So 16 years. Okay. All right. But that's not, I mean, I just walked you through, that was a decade of still profitable, but up and down and a lot going on. Okay. That's a decade. All right.
Yep.
No one can survive that. I mean, you can, I mean, come on. Like, practically speaking, the benefit I had is I was young enough and naive enough, and I had other streams of income to really keep me going, and that's just the heartfelt deal. And then what I did from 2010 to 2023, got me put in Unknown Market Wizard. So that shows you the change and the difference, right?
Yep.
And that's,
I love
but
that,
that's,
man.
yeah, but that's the foundation.
So let's highlight that though, because it took about a decade, like you said, to really
Yeah,
get your foundation
yeah,
solid. Because there's so many
yeah,
traders out there who've been trading for 3 years, five
yeah,
years, and they're beating
yeah,
themselves up because they see these people who claim they make money in a year,
yeah,
6 months, or
yeah,
whatever.
yeah.
What would you tell those people who have been trading for 4 years and they're like, man, I really love this. I'm kind of making money here and there, but I'm still struggling. Like, what would you tell them?
Um, I think anyone at 2 to 4 years, and I'm still open to it now at 24 years, needs to treat this like a business. Okay. And I would say, listen, all of us have an edge. All of our life stories are unique insofar as they can give us something that we can bring to the market that almost, as a practical matter, that almost no one else has. Okay. And so there's this concept when it comes to careers of hybridization. All right. Where you take two industries and you bring them together and you make yourself unique unto that. All right. Like, I just finished law school. I just took the Nevada bar exam. All right. I want to be unique when I launch my own law firm. Okay. Unit of Risk Legal Advisors. All right. That I want to be unique into, like, basically where the art of advocacy meets the architecture of risk. Okay.
Hmm.
And I want to be the consigliere of the capital markets. All right. I want to help people who are raising money, M&A activity, trading, financial securities, merge with people who want to structure deals and understand the law. So, like, as someone who's learned, speak 4 foreign languages, I want to take that larger metaphorical translation skill, okay, to translate markets, translate the law, translate those things, and then bring value to clients. So the same thing applies, at least at a large metaphorical way when it comes to trading the markets. If you have a background, okay, in dentistry, engineering, biotech, all right, you know, there is something that you have that probably gives you an edge. And so the first thing, and people say, well, what do I do? And I said, let's talk about, well, I don't have much money. And so one of the things that we can capture this is, take what is your perceived biggest weakness and make it your biggest strength. Okay. You don't have much money. Oh, what you really mean to say is that you don't have any liquidity constraints on a position. Oh, so you can actually get in out of something. You can trade something that's really illiquid and not suffer the detriment of trading something super liquid, because with 20, 30, $40,000, all right, you can buy a stock and buy 100 shares and sell 100 shares. And that makes you $300 or $400 a day, you know what I mean? Because you can do something, and that strategy doesn't scale to the next level. Well, right now with your bankroll, that's actually a benefit for running capital constrained strategies. Okay.
Hmm.
And then have that problem that, I'm making so much money that I can't actually deploy more capital. Well, that's a high quality problem. All right. And
Yep.
so that's what I'm saying, that everyone needs to recalibrate their situation. All
Hmm.
right. And attune it to what their situation is. What are my skill sets? What do I offer? What can I do? What's that? Oh, because you're a parent, you can only trade from 8 o'clock at night till midnight. Well, guess what? There's not a lot of traders then. So maybe your situation and the time it allows you to trade, become the protean trader. All right. That's why the
Hmm.
proteantrader.com, that's me. All right. So what does protean mean? Protean is a Greek word. It means versatile, adaptable, and able to take on many shapes and forms. I think it's a great name and a great characterization to be a
That is a
trader,
great name.
right? Okay, my wife is Greek, and the first thing she saw, my license plate, my BMW X3 says protean on it. And the first time I met my wife, we were, she's legit Greek. raised 21 years in Thessaloniki, Greece. All right, hardcore, has the Greek family, everything, and there's no time that my waistline does not expand when her family comes and visits because we're eating. All right, we are eating. You know,
Yeah.
so yeah. I've got the evidence to prove it. You know what I mean? I eat very
Yeah.
well with a Greek wife. Okay, so the bottom line though is that like that is, are you adaptable, are you versatile? Okay, we're in a world of AI. All right, what you can do now with
Mm.
chat gpt is unreal, like with
It
the right
is.
idea. I mean, chat gpt is an absolute force multiplier. It will amplify, it will accelerate, it will take your ideas, your ability to research, your ability to structure something, and give you an edge that you can capitalize on those small little tweaks, those small little anomalies. They can make that go from there. Do you think you're going to outwork, the big hedge funds out there, the people who have like tons of research, tons of stuff? No, but understand that there are things that get through the cracks because they don't scale, right? So the first thing you got
Mm.
to be is that catfish at the bottom of the ocean. All right, it ain't very sexy. Actually, it's more of a river. Catfish at the bottom of a river. But you know what keeps that riverbed clean? Is that damn catfish picking up the scum at the bottom of that riverbed. Okay, so go get that. And have you ever seen a skinny catfish, Alex? Ain't no skinny
No.
catfishes. They're all
Nah,
fat.
they're big around.
They're
Yep.
big and round, right? Okay, so be that
Yep.
fat catfish, okay? And don't be afraid to pick up some of that scum at the bottom of the riverbed.
Yep. Yep. You know what I'm curious about, and this came to my mind with that decade of experience. I'm sure there were strategies you tried that just flat
Yeah.
out just didn't work for you.
Yeah.
Has that have you, now that you're 25 years in, have you sometimes gone back to some of those and brought them to life and they do work? It's just you didn't have the skill set back then to really make them work. I'm just curious.
Um, yes and no. I'll say yes in this. So what's been consistent, like since the beginning of my trading career and even till now, is that the markets tend to trend much stronger and longer than just about any of us can accept. Okay, and that the majority of your P&L is likely to come from a set number of days throughout the year. Okay, and meaning setting limited number of days throughout the year, and the rest is going to be a wash. Okay, and so being that that's a principle that's been around since the outset, being able to capture those big days was a skill I didn't have in the first decade of my career, anywhere near the extent that I have it now. Okay, I
Hmm.
can put on a trade with asymmetrical risk, meaning a 4-to-1, 6-to-1, 8-to-1, understand the metrics behind that, and see, because I've seen this before, and with cold blooded assassin like confidence, execute that position. Okay, and
Hmm.
just know that like whatever happens happens, but this is, and appreciate that this may only happen 3 or 4 times this year or 6 times this year. And so that understanding that this is going to possibly, be, when you wash everything else out, my P&L for the next 2 months, uh, you know, I have that appreciation more. And as a consequence of that, I can manage that trade better, and spot just the uniqueness or the novelty of that trade.
What would you say has been the biggest weakness of your strategy, of you trading as a person up until that 10th year? But I know you said you couldn't identify the big moves and you
Yeah.
couldn't capitalize. Was that the only major issue you might have had? Or was there some like strong, whatever it may be, that kind of held you back the longest and you finally overcame it and that helped you kind of really grow after that 10th year?
I would say that the biggest thing that held me back was probably self doubt.
Mm.
Our intuition is a byproduct of the analysis performed by our subconscious. Let me say that again. Our intuition is the byproduct of the analysis performed by our subconscious.
Mm.
Okay. And I had picked up on a lot of things. And there's a lot of, not a lot of, there's a couple famous psychological studies out there, which have us doubt, our own ability, that we notice something because we figure everyone else out there probably already knows this, and this can't
Yeah.
possibly be the case. And so I would say overcoming that doubt and actually having the confidence, um, and believing that I was worthy to do this, at the full level. I mean, again, maybe I'll ask the question because now, as a lawyer, that's how I think. It's like, well, you wrote a book in 2004. You know what I mean? You mean you didn't have it all together at the time you wrote a book? Like, I mean, I had a pretty good system then. I had a pretty good structure, and there's a lot of value in one shot, one kill trading. But I was nowhere near evolved as a trader as when the global macro edge came out in 2016.
Mm.
Okay. In 2004, when one shot, one kill trading came out, It's a very robust technical trading system, synthesizing the Joe Napoli fib levels and other things that I learned in terms of inflection point trading. And that's really what it was a lot of inflection point trading. But I didn't understand the macro narrative. I understand monetary policy, even superficially. Okay. I didn't understand all the corporate earnings dynamics, even superficially. Okay. I mean, I knew there was an earnings announcement, that there was a Fed decision. I want to be clear. It wasn't like I didn't know they were there, but I
Right.
just didn't understand all the nuance behind it. I didn't understand, quantitative easing. Or, I mean, if it would, I understood in 2012 when it came out, but what I mean is I didn't have that macro narrative behind what I was doing. And that would make it so that when there would be a regime shift, and we'll talk about that probably later in this interview, that I couldn't put attach qualitative risk metrics on top of a quantitative or technical trading strategy. And that was the
Mm.
transition that really happened around 2010, 2011, 2012 because of the great people I synced up with and who mentored me from there. And so the global macro wedge is a manifestation of that mentorship, of that journey, and then really of the performance. I mean, we talk about, I hired a CPA, Mike Coglianese, a very well-known, well-respected CPA out of Illinois. Does a lot of work for a lot of CTA hedge fund types. And he came and audited my track record for that previous 6 years from 2010 through 2015. The book was published in 2015 or 2016, so that had that previous 6 years, and then you give publication delay times and whatnot. We came out, I think, in a pretty timely way. But I want to show everyone that not only were the mentorship there, but if you're going to pay $150 for a book and spend not even just $150, but really what's going to be hundreds of hours of your time reading through this, that's actually worked. And we wanted to
Mm.
validate that. We wanted to provide that early on in the book so that, hey, you're making this investment in time and you're learning from people who have made money, who manage a lot of dough, and from a trader who's quarterbacking all of this, that is synthesized in a way that is statistically irrefutable in terms of its success, at least based on past performance.
Yep. Yep. And what I love that you hit on that I think is going to resonate with so many people is that self doubt and the subconsciousness of when in the words you used of like it's just basically your subconscious just telling
Mm-hmm.
you
Mm-hmm.
by over years and years of just
Mm-hmm.
looking at markets, right? You start
Mm-hmm.
to pick up on things and you
Yeah.
have these
Yeah.
urges like, oh, this is a like, this is a huge drop in the market at a key
Yep.
level. Like I feel like this is a great opportunity, but like the hesitation there. How did you get over that self doubt? Even because you
Journaling.
were self doubting even after making money. So like
Yeah.
some people are self doubt and they're not making any money right now, but they still have that subconscious telling them like, you need to get in this, and they might pull the trigger, but that self doubt gets them to get out too early for a small loss when it shouldn't have been, so forth. So how'd you really overcome that?
Yeah, journaling's a big deal, man. You talk to every top trader, Paul Tudor Jones, they'll tell you about the importance of the trading journal, because otherwise what you have there is, well, I felt this way before. Yeah, well, how many times before? 20,
Mm.
30, 50? And how many times did it work out? Well, if you have a trading journal and you write in that trading journal like from both an ex ante and ex post perspective, so ex ante meaning before the fact and ex post after the fact, and that's important because if all you're doing is writing that trading journal ex post or after the fact, then you tend to like throw some um, you tend to blur or rewrite
Mhm.
history in terms of what you actually thought. Okay. And
Yep.
all we want is the truth. There's no ego here. I mean, there's an ego, but we want to manage that. And so, listen, if you in the last 50 times had this feeling at X conviction point, 0 to 100, I think that's a good way, not 1 to 10, but 0 to 100, it's being granular without being too granular. Okay. Like you can, I have a feeling of 77 here. You know what I mean? And here's why I think this is the case. Okay. Da, 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 da. And that like, and then you can attach a confidence interval to this feeling. Now you've done it 50 times, and man, 40 of those at 50 times, this is what happened over this subsequent time frame. Well, if you don't have that actual quantitative recording of those qualitative feelings, all right, do you really know? What I feel like
Mm.
I feel like the last 10 times I felt this way, it did that. Well, did you really feel this convicted? Or were you like a lot more doubt? And you had five factors in your favor and one factor against you, let's just say, for the sake of this example. And that
Sure.
one factor really dissuaded you materially. Okay, well, so without the quantification or the journaling or the memorialization of those ideas, it's very difficult to overcome that. And so I've been a very fastidious record keeper in my time. Like I keep detailed records. I have trading journals going back decades. Okay. And, I talk about in the Golden Macro Edge my use of Evernote and other cloud based applications. And so I can dig up economic events, Fed policies, and my notes around them, not just, what sits on Google, but my internal
Yeah.
notes ex ante of what I thought before that event, the pricing behind that. And I have other commentators that I put, I record other really macro strategists that I respect. I put their comments before the fact so I can go back and say, okay, what was
Hmm.
the street thinking here? All right. What was the street actually looking for in this number? Because I think that's a lot of the story. And then I can, of course, find those analogies and then trade from there.
Is there any, because everyone does talk about journaling, right? And I'm sure everyone journals slightly different. Do you feel like there's like a core that you should always make sure is part of your journal for the new traders out there, that no matter what, you make sure you journal this?
Yeah. So chapter 8, and I'm sorry for the shameless plug. So I'm just trying to
Oh, no, not at all. Go ahead.
synthesize this, to give a snippet, give a concept, and then if you want to, read more about the concept, here's where you can
Hmm.
find it. Okay. So
Yeah.
chapter of the global macro, I just spent a lot of time talking about. In fact, I think you can make a really good argument that chapter 8 was maybe my most enjoyable chapter to write,
Okay.
because it deals with creating a unit of risk system around you and memorializing that, and the importance of a trading journal. And because this is the one thing that seems to transcend trading style, trading history, trading background, that all these top traders agree that memorialization of your ideas, both from a trading perspective and a psychological perspective, does that. So to your question, it's ex ante, meaning here's the trade, here are the reasons why I'm taking the trade, and this is a very distilled down version. There's much more detail in chapter 8, but here's the trade, here's what I'm risking, here are the reasons why. Okay, then the follow up. Here's what happened during it. Here's the result. Here's what I did really well. Here's what I could have done better. Okay. So there's a call to action. So it's the prediction, the size, the risk you have, any sort of contingency plans, generally speaking, you'll adapt to it. You may change. All right. And then how the trade played out. Okay. Your postmortem, and then a grade of how you did and what you could do better. All right.
Hmm.
And I regard that last part as actually trade preparation for the next trade. It may sound a little bit paradoxical, but why does the way you record a previous trade count towards your trade prep for the next trade? Because I think without that memorialization, without that post-mortem, you make yourself vulnerable to repeating the same mistake in the subsequent trades.
Hmm. You know, would you, for traders who are very active, like daily day trading every single day, picking
Yeah,
maybe 5, 10 plus positions,
yeah.
would you recommend them do that journaling at the end of the day, during the day? Does it matter to you? Just curious. At least the postmortem.
That's going to be dependent upon just that person's individual. And let's be fair here,
Okay.
like, you don't want perfect to be the enemy of good. Okay. And
Mm.
so, like, if you're taking 20 trades in a day, I think you can summarize those, obviously capture them, have them in your trading journal, do the according, I always screen capture. I use CQG. I always screen capture my fills. I always screen capture the charts. I put them in my Evernote, and I journal them up, and every one has a similar consistent theme to them, things we just talked about, and then some. Um,
Yeah.
but yeah, but obviously doing all that for 20 trades in a day, you'd be at it for 4 or 5 hours.
Yeah.
Like, so that's not practical. But what is practical is, well, my thoughts come into the day. Why did I get in these series of trades? What was my idea behind them? What did I learn from these series of trades? Okay,
Mm.
that's very practical, and that's part of the evolution process. And now with ChatGPT, and AI, you can synthesize that even further. ChatGPT can now take these things, screen capture, throw in ChatGPT. Um, It'll provide a synopsis. Teach ChatGPT to be your consigliere. That's what I've done. All right.
That's
To the point
great.
that ChatGPT is like, John Netto, you are wearing me out. Yes, that's right.
I,
That's right,
I love it. I
ChatGPT.
love it.
Wearing yo ass out.
Yep. Hey, you know what I love about that? Because everyone's who's listening to this probably not even using ChatGPT to help them journal. That's something I actually been thinking about doing. I
Yeah.
don't use it yet for journaling, so that's something I would look into more. What I'm curious about
Just
next
create a
is,
thread in ChatGPT. It's easy. Just pop up a thread. Hey, ChatGPT, create a Google Doc or whatever. Here's my trade journal. I want you to remember everything I tell you here. Okay, and especially ChatGPT 5.0 is much more robust than 4.0. It's only been out like a week, and this interview may not age well. It's August 18th today, 2025, and ChatGPT 5.0 came out last week, and I've just been blown away by. I mean, one of the hangups of 4.0 was like, you were constantly, at least I found myself constantly reminded of, because I do a lot of three-dimensional cross-sectional analysis, and that's where AI can get stumbled up, and it would just repeatedly come up with the wrong memory. So that's not what I told you, ChatGPT. That's not what I told you. So, but 5.0 addresses a lot of those things, and is just a, I mean, 5.0 was humming. It still has some shortfalls to it, but I've really amped up and amplified the usage in it. Any moment in time, I have a repository. I mean, AI is just absolutely game changing, and it's part of being protean. It's part of being protean. You know, you adapt to it. You have these
Yep.
tools. I assure you, a lot of other traders aren't using ChatGPT like I am. You know what I mean? But
Oh
they
yeah.
still will be. You know, people will eventually grow into this. Technology and the market as a whole will grow into this. But it's an amazing thing for your research, for your ideas. I would say that ChatGPT, in terms of, you know, I'm still teaching a lot of the macro stuff. I've uploaded Global Macro Edge chapters in there and try and teach it, but there's just a lot of multi-layered cross-sectional analysis that it still doesn't intuitively pick up on yet, from the AI standpoint. So we're safe for a little while, you know.
Speaking of the AI, since you brought that topic up, I
Yeah.
I want to know what is your thought process on, some people throw up the whole doomsday of trading, like what's the point of trading because AI will take over and no one will be able to trade after that. What's your thought process in the next 10, 15 years, how trading may evolve? You think we'll still be active day traders? You think there'll still be people pressing the buttons? Just curious.
Yeah, I think the themes that we, you know, fear. This is one theme that's been consistent since I've started trading. If you fail to evolve and improve, you will be left behind.
Mm.
And that's not an AI thing. That's just a market thing. Okay, because the market is maybe at not the fastest pace, but the market does get better. And I would say this as well, and that is that markets are still a consequence of supply and demand. There's still a consequence of economic and monetary policy consequences. And so AI is only as good as the information it has to process and make predictions. Okay. And there will always, I believe there will always be market microstructure events, because that assumes that everyone is, again, it comes back to this, you know, concept that's rooted in hundreds of years of economic doctrine. That is the rational person test. All right. That assumes that all these people are still going to behave rationally if you subscribe to that AI theme, okay? And the markets have shown us throughout history that they are anything but rational. Now, that's what the whole volatility metric comes in. And so we talk about geopolitical risk. You talk about, I'm sorry, are you saying that every global leader is now going to make every decision based on AI? That's a bit intense. And the people who have the ego to become president, you think Donald Trump sits with his chat GPT, all right? And like he has chat GPT
No.
determine what he says? Shut the front door. Just shut the front door, okay?
Yeah.
You think Vlad Putin? I'm not saying Vlad Putin hasn't used AI like in the Ukraine thing. I'm not saying he hasn't used it, but ultimately people get stuck, you know? And AI may help you manage a position, but to suggest that these people whose personalities are predicated on their egos are now gonna, like, subsume, or are now gonna, acquiesce to AI. It's just not. Humans are unique, and markets are uniquely human. And so,
Mm.
while procedurally and mechanically AI will continue to evolve and grow and make us more efficient, it still is a market of expectations about future price movement, and serves as a discounting price mechanism.
Look, John, I didn't want to go over. I didn't want to like ignore what you said earlier, so I'm bringing this back, and that's just because people are going to hear that you said that you just passed the bar exam,
Mhm.
and
I took the bar
you know,
exam. I find out in 6 weeks if I passed or not, but hopefully I passed it.
okay, okay. So people are probably like, why the heck is this guy who's very successful, who's accomplished many things, been in the Market Wizards, Unknown Market Wizards book. Why is he going to try to become a lawyer? And I know you said you want to combine the two. That makes sense. But do you find yourself like always trying to do better? Like, I mean, I'm just curious, like what drives you to keep doing more when you've already accomplished so much?
That's the paradox. People who accomplish so much, I'm not saying that's me, but got there because they always want to do more.
Mm.
Okay, like so woo.
Easy answer.
Yeah. Listen, I've been very blessed. Having been a Marine Corps veteran, I received the Veterans Administration scholarship to go to law school. Had everything paid for. UNLV, the Boyd School of Law here in Las Vegas, a really special place. They have one of the most well-known, respected part-time night programs in the country for law school. So it allowed me to while being a full-time law student and doing some really amazing internships slash externships, working for judges, etc. It allowed me to raise a family and adapt a schedule around that. And within 3 years, I managed to get a law degree, um, graduate magna cum laude from a very well-respected law school, work at the Nevada Supreme Court, work at the Discovery Commission. So I've learned a lot about appellate advocacy, learned a lot about pretrial litigation. Uh, I'm now getting an MBA. And so I want to put myself and ultimately launch my own law firm, Unit of Risk Legal Advisors, when that day comes. That's my goal. That's my plan. And be the quarterback, be the maestro, be the orchestra, be the person, be the composer that merges finance, all right, and be that translator. I've learned 4 foreign languages: Japanese, Chinese,
Yeah.
Portuguese, and Spanish. Okay, and the
Insane.
language of law, the language of finance, the language of trading. Synthesize all of those together, and we talked about at the outset of this, the hybridization, you know. And so I want to be the consigliere of the capital markets. Take
was
25
there a
years of
time
training
where
experience. Yeah.
was there a time where you did kind of rest on your success? Just curious. Like, I'm just curious, was
Um,
there a period where you got success and you're like, oh, I'm just going to do this, and then you got something happen where you're like, fuck this, I want to do more? Like, I'm just
yeah.
curious.
Um, I don't know, rest on success. I think, listen, there's something to be said for continuity in one's life and consistency. And if you find yourself in, markets that are very fertile and receptive and produce a lot of alpha, you want to exploit and maximize those, because we all know that markets can go from being very giving with opportunity to taking that away. And so
Hmm.
I think it's about striking when the iron's hot and make hay when the sun shines. Um, but the reality is, I just got a JD. I just graduated law school. I just took them about a bar exam, and now I'm finishing up an MBA with a focus in accounting, mergers and acquisitions, and taxation. I took multiple taxation courses in law school, so I understand tax law at least superficially. I had a great professor, Professor Lippman, who was a Nevada tax commissioner. She's published what must be 80 or 90 academic scholarly pieces. And so I had a number of those professors. It's about increasing our market IQ, increasing our entrepreneurial
Mm.
IQ, increasing our legal IQ, increasing our life IQ. Okay.
Mm.
And that process of increasing ensures that we're not regressing, and ensures that ensures that we can see things from different perspectives, ensures that there's litigation trades out there now. I can actually look at a company,
That's true.
let's take Amazon, and I can now analyze their legal case that they have, use AI to synthesize that process, because the procedural docket for the things is extensive. There's thousands of pages that go back and forth between motions, complaints, filings, answers, etc. Synthesize that, and then use my understanding as having worked as in both the chambers of a Nevada Supreme Court justice and a discovery commissioner, of understanding how chambers work and how these information items are released, to like now take my economic event trading acumen and the fact that I developed proprietary software around that, and now trade judicial outcomes and now manage risk around. So like it's all about. Let me say this, and I'm kind of talking here, but let me say this. When you say, why'd you go to law school? Well, 3 years ago, all right, I had the conviction. But here's the thing, Alex: clarity succeeds conviction, it doesn't precede it. All right? It means you find out the reason why you do something oftentimes after you do it, not before. So be
Mm.
comfortable not knowing all the reasons why you're taking that trade just yet. Be comfortable knowing that you don't know all the reasons why you're gonna like propose to this woman. Okay, be
Yep.
comfortable for all the
Yeah.
reasons why, because conviction comes 10 years after you're married. It makes a lot more sense why this woman was so great that you married, or why your spouse is so great. 10 years later, it's clear and obvious why I went to law school, because now I'm involved in M&A deals, and now I can see the market in ways I never could see before. All right.
Yep.
So
That's a good point.
conviction precedes clarity. It doesn't succeed it.
And look, to get back into some of the things that you've written about, you've also talked about the Netto number. Would you
Right.
mind kind of diving into that just briefly and
Yeah.
giving people an idea of what that concept is?
Sure. So I spent 25 years, well, at the time, 16 years, just in the gauntlet and in the trenches of futures trading warfare. Okay. And risk has been defined usually at a one-dimensional level, and if you're lucky, at a two-dimensional level. And what the Netto number does is define risk at a three-dimensional level. Okay.
Hmm.
And by one-dimensional, I mean, what did your portfolio make last year? Oh, it made 10%, made 15%, made 20%. And that's the conversation that most people have. All right. And so from a two-dimensional level, you have institutional metrics like the Sharpe ratio, the Sortino ratio, and they tend to measure returns based on those returns relative to that realized volatility. And that term realized is very important.
Mm.
By realized volatility, it's what the volatility of that portfolio was at that for that respective time period you're trying to analyze it under. What the Netto number did, and what makes the Netto number three-dimensional and distinguishes it from those two previous methodologies, that first and second dimensional methodologies, the Netto number not only measures the performance, and it not only measures the volatility, but it measures what the risk budget was before that performance started. So why is that important? Let's take an example of that. Okay, what the Netto number does. I give Alex B. I say, yo, Big Al, here's $1,000,000. Okay, coming in hot. You got this? You got this, Big Al? You gonna do this?
I got it.
Exactly, you got it. But here's the deal, Big Al. You lose 200 large of that 1 million. You go down 200 large. I'm talking like a bookie now. All right, you go down 200 dimes. Okay, you lose 200 dimes of that million. I'm cutting you off. All right. So if you fall to $800,000, okay, then I'm cutting you off. So you have a $200,000, 200 dime risk budget for all you bettors out there with the NFL season coming up. Okay, and so now give another person $1,000,000 and they have no risk budget. All right. So your flexibility premia, all right, is far less. So at the end of the year, that $1,000,000 that you make, let's say you fall to $900,000. Okay, you go down 100K, then you end up making me 300 grand, so you end up at 1.3 million, and the other person ends up at 1.3 million, and maybe they were down 250 or 300. All right, but you guys both end up with the same performance. You're both at 1.3 million. Now the Sharpe ratio will tell you, okay, that your returns are better on a Sharpe basis, but you don't have that last piece. All right, and that is what your risk budget was. And so the Netto number, I'm not going to get into the formula itself. It's in the book. You can find it online, I'm sure. But the concept is that the Netto number through the denominator, all right, that's the bottom, that's below the dash, okay? The numerator over the denominator. The bottom part of that incorporates both the max adverse excursion, all right, and your predetermined risk budget. So I measure both how much you lost in my principal, because I don't want to punish you if you're taking shots at profits. Because if you're pressing winners, I want to reward you pressing winners. But if you're losing money from my principal, if you come into my money, don't come into my money, okay? You come into the market money, you can do that, okay? But don't come to my money, all right? So I'm gonna punish you for that in that denominator of the Netto number with the maximum adverse excursion, okay, MAE. And so that what makes it the denominator is that both your predetermined risk budget plus your maximum adverse excursion divided by 2, and that's your denominator. And that adds a three-dimensional component, the Netto number, that just isn't out there, hasn't been created. I came up with that and published that in 2014, and then it came out again in 2016 as part of the Global Macro Edge, as part of the Global Macro Edge is maximizing return per unit of risk. That's how you define return per unit of risk.
And for those listening, why do they want to even try? Like, why would they even care to use that? Like, it's for the layman people, like even myself. Like, why does that matter?
Why does that matter? Because every one of you mofos is trading on leverage. That's why it matters to you people out there. Every one of you guys is on margin. Exactly. Go bury your head, Alex. You want any more dumb questions? Okay.
No, hey, that's my job.
I say that with love. I'm saying that with total love. Okay. All right. You do that because every one of us trades on leverage. All right.
Yep.
So don't you want to know what your return per unit of risk is if you're trading on leverage? All right. Because don't you want to know what you can actually risk? Okay, based on this system, based on this strategy, don't you want to know how much you can gear that portfolio? How much you want to? Institutions out there are all about risk leverage and they're all about gearing portfolios. So how much risk and how much leverage you can use can only be truly answered if you have a viable metric that tells you what your ex-ante risk was. And if you don't know the risk budget, you don't know shit. Okay.
Look, now I'm curious to kind of shift subjects here a little bit on algos and strategies.
Yeah.
Do you find that to be something that retail traders should pay attention to, today or maybe more in the future? Like, what do you think the impact is on that?
Algorithms in general, in terms of just algorithms are prevalent throughout the market. They're used at the most basic level. The trading platform you're on at some level uses an algorithm to route your trade through the computer code that it has or do you mean?
I guess I mean more so like algo strategies that are just automated by themselves, doing its own thing.
Okay. Yep. Okay. Sure. Listen, I'm going to go back to what I mentioned earlier. Like, take what you perceive as your biggest weakness and make it your biggest strength. Okay.
Mm.
If there are algorithms in the market, what are their tendencies? What are their qualities? How adaptable are they? Okay. Because if someone's running an algo, they're going to have that algo is an extension, a manifestation of that, of instead of that person having to sit in front of the computer, they have this structured, rigid, predetermined metric which determines, how they're going to execute trades. All right. But that
Mhm.
doesn't mean that the problems go away. It doesn't mean that, well, when do you cut this algo off? What's the risk budget behind this algo? All right. Those are the hard comments. Is the risk budget, like we just talked about, based on pure emotion? Well, I don't know. I didn't have a risk budget. And that's why I say if you don't have a
Mm.
risk budget, you don't have anything. All right. And so otherwise, what ends up happening is you lose and you feel bad. Well, the algo doesn't feel the way. The algo is just doing what it tells you to do. Okay. And so how exploitable, how gameable are these algos? Do they demonstrate behavioral patterns that can be exploited in the market? And so,
Mm.
again, I'll go back to this. The only one of the few things I've seen in my 25, 30, 35 years of the markets, going back to, my adolescence, is that if you fail to evolve, if you fail to take the idiosyncratic aspects into account in the regime that you're trading in, that regime, you're likely going to struggle. And that's been consistent for 40 years now. Okay. And I don't see that trend going away.
Okay, John. So we've really dived deep into your story and how you got to where you are today. So what I'd like to take some time now is to kind of go over maybe one of your trades that you've taken in the past. Maybe go over big picture idea, how you found it, why you even were interested in it. And then if we have more time, go into sharing the screen and evaluate and showing us, how you actually execute the trade. Is that okay with you?
Sure. Yeah.
Perfect, perfect.
So,
So go ahead.
listen, I've been trading gold for close to 25 years now. A lot of good, some not so good. Was a part of actually a gold commodity pool operator back in like 2007, 2008, where I was the series three for that. So I definitely have some administrative and substantive experience in trading the gold market, etc. What we saw in the last 12 months, and we talked about, we at least touched on about what the importance of the regime is and the importance of the macro narrative. If you can blend and harmonize, um, you can harmonize the technicals along with this fundamentals, the fundamentals that are attracting inflows and capital. You can really create a lot of asymmetrical, really nice, high reward, low risk trades. Okay, and so let's just speak thematically about what happened where we have this long time correlation where forever, and again, you've gotten in a lot of trouble with this. A lot of the gold books out there talk about just the decay of the dollar. Okay, talk about that our government's in way too much debt. Okay, and that our government really, can't sustain itself. And what we began to see for the first time, or at least in a meaningful way, I can't say the first time, we began to see in a meaningful way in the middle part of last year was a bit of a decoupling between the way yields were changing, meaning the yields on the 10-year treasury were trading, and the way that gold was trading. Okay, and what I mean by that is that when yields would go down, gold would tend to rally. Okay, because that would reflect at least the Fed was there's some weaker economic data out there. The Fed may cut interest rates. That cut interest rate would weaken the dollar. That weaken the dollar would then help gold. Also, the cut interest rates that was symbolic of possibly some economic trouble going on, which would also, keep yields on the 10 and 30 year, even the 5 year to some degree low as well. So you get this, when 5, 10, and 30 year treasuries would rally, and i.e. yield would fall, okay, gold also would rally as well. And we saw a pretty big divergence from that at the end of last year, as I'm not going to say for the first time, but in a very meaningful way, the debt servicing costs of the United States government began to become a real factor and a real talking point. And you saw this decoupling from gold, and not unsurprisingly, Bitcoin as well. And so you have these now store of values, because forever gold bugs have talked about that when the system crashes and whatever happens, and I've been a part of that argument that gold represents this store of value. Well, gold as a store of value play really began to emerge last year. I mean, even this year, 2025. My last year, I mean, end of 2024, but definitely in 2025. So this is what this looks like. I'm gonna go ahead and share my screen now.
There you go.
So now what you see here is all these, this is the daily chart of gold, okay? And what ends up happening is, gold goes on a really rip shoring run, As I talked about in terms of the global macro edge, buy weakness in rising markets, sell strength in falling markets, and take profits at predetermined price points. Let me say that again. We talked about that earlier in the episode. But buy
Say it
weakness in
slower.
rising
Say it
markets.
slower.
Yeah, buy weakness in rising markets, sell strength in falling markets, and take profits at predetermined price points. Okay, so that's great as a standalone. But if you don't have that context of the macro narrative, if you don't have that appreciation of what may be taking place, all right, that's the third dimension of your trade that can really take your, when executed right, that's always the qualifier, right? When executed right, can elevate the not only your profitability incrementally, but also the conviction that you hold while you're in these positions to begin with. And now overlay that on gold futures, because I'm a long time futures trader, where there are daily options on this. So you can take like a move like in here in early April, all right, where gold sells down and what's in a pretty clear uptrend, all right, and you can compartmentalize that risk because we've seen in the past where gold could be down $80, $100 in a day. But if you're paying $10, okay, or $15 for a 2-day call option on gold, all right, and gold goes from, let's say 3,025 to 3,200, in 24 hours, if you're paying $15 for a market that moves 150 bucks, that's pretty nice. But more importantly, it's not that you're going to catch a $150 move or a 10x on your option. It's that you've now compartmentalized your risk in an uptrending market, and you can now buy the dips as a consequence of that. And there's other option structures as well. So if I were to buy, let's say, a 3,100 call and sell a 3,200 call over a 2-week period, I can create, depending where we're at in this option window, a 5-to-1 risk to reward ratio based on that call spread. Now, you may not want to sell the other leg of that call spread, meaning if I buy the 3,100 and sell the 3,200, given where implied volatility is at, you don't want to actually sell that back end of that leg because that presents some management dynamics, when you're right. When you're wrong, though, you have some other optionality. You can, let's just say you buy this, you put on a 3,100, 3,200 call spread, okay? That trade goes against you, all right, initially. You can lift and get out of that 3,200 call spread, then you just own the 3,100 call outright, and you can then manage your deltas around there. And so, I've been trading options for 20 plus years now, but this is where, when I talk about, and I'll say this term again, temporal granularity. That's temporal granularity, meaning the time frame with which you trade can be isolated, and you can find an option expiry that's never more than 24 market hours away. And the fact that something's not more than 24 market hours away provides a lot of risk compartmentalization and latitude around how you can manage these positions. And this gold position, superimposed on top of this narrative where you're seeing institutional flows come in. And the reality is that if you understand how these big options market maker firms work, they're big data. People say, well, how do you outlast AI? How do you outdo big data? Well, how you outdo it is that big data can really struggle with idiosyncratic variables and regime shifts because big data is predicated upon 10,000, 50,000, 100,000 data sets. And so that is your biggest strength. So if you're pricing on something on these really rich data sets that go back all this time, there's a potential, and they have tweaks for this as well, but that's not part of this show. The potential that there's a lack of dynamism around how fast those options can reprice in a market. And that's where, the first 5 to 7 days of a new regime, these option market makers, especially with these daily options, they just simply can't reprice fast enough. And gold was a trade that had that. And well, I'm not going to say structures like this because, I've talked about where there weren't daily options 10 years ago, but I'll just say conceptually, finding market microstructure inefficiencies combined with macro narratives that are conducive is how, I generated the 40 plus annual returns that are cited. And I'm only citing what Jack Schwager said in the book about me in Unknown Market Wizards. And he verified independently, and I hired a CPA to verify independently. But that was the process from, at least conceptually what I did. Now, how I manifested that process has taken on many iterations and forms, but that's effectively, this is a glimpse into that. And I would again encourage you that if you are more curious, the 600-page book, The Global Macro Edge itself, it may take you a year to read, but if you want to be at this fluency of market analysis, you're going to have to invest something. And that's your time and your money. So that's what it is.
For those who are aware of options lingo, right?
Yeah,
And as well as myself, I don't touch options. I'm curious, is there any way you can kind of reiterate or explain this to the audience who are more newer to the world of
sure,
options or even just trading in general,
sure,
and how
sure.
you saw this and how you structured this trade? Because I'm gonna be honest, I don't personally understand the options lingo, so I'd
All
love
good.
to kind of get this in a more layman's terms.
Thank you for reining me in. I need someone to do that because
Yeah, no worries.
okay. So an option gives someone, and I'll start super foundational, and we'll evolve from there. Okay. So an option gives someone the right, but not the obligation, to purchase something at a certain price. Okay. So an analogy can be it's if you're selling options, you're effectively selling risk. The same way an insurance company sells auto policies. There's always a risk that you get in a crash and they have to pay for it, but it comes down to pricing that risk over or life insurance. And there are these actuarial tables or tables which determine the probabilities of something happening. And so an option is simply a way that you can express that event as manifested through an investment between a buyer and a seller. Okay. And so I'm going to say here, hey, listen, I believe that gold is going to go higher. Okay. And I believe that the metrics that are used, that the factors that are used to determine an option price around gold do not properly account for factors A, B, and C. Okay. And they don't
Okay.
properly account for that because of whatever the reason is. All right. I happen to implicate the way that big data and the way that financial modeling has some blind spots in it. Okay, and so if I can then take advantage of that, because the pricing of these options, which over the course of 10,000 options is actually pretty good, but more idiosyncratically or more specifically, there's always bits and specks of those. Let's say for every 10,000 options, 50 of them are not priced correctly. So it's our job as option traders out there to drill down on the 50 that are not priced correctly. And what helps me determine that is be able to implement these qualitative or these fact specific instances that provide a point of differentiation that can get overlooked or overshadowed by a large data set. And so options let me buy with a defined risk. Okay. So gold right now, I can buy a call option on gold tomorrow for about $12. Okay, $12.
Okay.
And keep in mind, gold's trading at 3,050. So if gold's trading at 3,050, in order to get to break even, I have to get to 3,062. Okay. And that's a very one-dimensional approach on that gold option. So, we're actually gold's actually at 33.9. So gold's at 33.92 right now, kind of consolidating in here. And this is on August 20th, 2025. As you're looking at my CQG screen. Yeah, and so I could buy tomorrow, let's say 3,400. If I think gold's going to go up, I can buy the 3,400 call on gold tomorrow for about $8. All right, seven
Okay.
bucks. And so gold's got to get to 3,407 tomorrow to break even. But no matter what happens, Alex, I can't lose any more than $7 or $8. Period. Okay.
Hmm.
And so there's gold options priced at every level. So 3,410 is now $5. 3,420 is going to be $1.50 or something, or $2. 3,430 is going to be 80 cents. All right. So what
Hmm.
happened if you bought an 80 cent option and gold rallies $50? That 80 cent option is going to be worth about $20 in the day, or pay back a pad of like 25 to 1.
Hmm.
Now, how often
Okay.
does gold rally that often? What can contribute to that? So those are some of the, again, idiosyncratic factors that can help you find those opportunities. And that's why I say when you have options expire every day now, no one says you have to trade every day. But if a situation that's unique that you understand comes up, the fact that you can trade something that expires that day can help you achieve an outsized return, because the option market
Hmm.
maker probably there's a chance is not priced in that event correctly, or maybe they have. But that's where you can make that determination based on your modeling and based on your research and based on your fluency of those things.
So in other words, you going back to the trade you took, you said you bought
Multiple
the
trades. Yeah.
3,100 calls,
Yeah.
right? And then you also sold 3,200,
Sure.
right? Why did you do that? And how does that make sense for us? And also the listener listening in, like, what's that? Why? Just curious.
Yeah. So, and that's why I talked about now. So when you let's go to this 3,400 trade we just talked about now. All right, the goal's
Sure.
33.92. I'm gonna buy 3,400. It's $8. Okay, but if I sell the 3,420 for let's say $3, now all of a sudden I'm only paying $5 for that option. So I've reduced the cost. In exchange for reducing the cost, I've also capped my upside as well. And so people, as a way to take on a more risk defined or to mitigate some of their risk, they'll forego some of their upside when they buy an option, and they do that through spreads. Okay, and so they say, okay, I'll buy this spread, and
Okay.
correspondingly, they'll also mitigate their downside. All right, because if I'm selling
Yep.
options, okay, I'll sell you the 3,400, but then I'm going to buy the 3,420 because I don't want this thing running against me unfettered, unchecked. And so by buying the 3,420,
Right.
yeah, I got to give up $2. But now, if gold has a big day, I at least know where my risk is capped. So that goes both ways. So people will buy and they'll trade these spreads to both minimize what their outlay is and also minimize what they could potentially lose. All right, if they're the seller on the other end of it.
That makes sense. Okay. So basically, you were minimizing your risk, but also minimizing your potential reward
No,
by
completely,
selling
completely.
3,200, buying the 3,100. So you had a $100
Yes,
spread.
yeah,
Okay.
and that's
Okay.
and that's what happens. And so there's a lot of considerations that are well outside the scope of this interview, which you want to contemplate when you decide that. But yeah, that's the gist of that.
And the whole premise of this trade was number one, buying weakness during strong
Sure,
markets,
sure,
and then along with some other big picture ideas
yeah,
that you had in
yeah,
regards to the regime at the time, the
yes,
situation with gold,
yeah,
and how political we were about the dollar and so forth at that moment.
right, right. This
Okay, okay,
decoupling that as gold has taken on a store of value now, it had broken all
because that's a
time
big
highs.
rally for gold right there.
Yeah, no, I mean, and now you see it consolidating, which we can talk more prospectively. This I think is very constructive price action. Gold's gone from a melt up from March of 24, from 2,000 up to 3,500 in April of 25. Or yeah, April of 25 to 3,550, and it won't give it back. Like it's just look at this. It's not giving it back. It's just building a base. And
Yep.
so, I mean, if you've been buying options on the call side the whole time, you're probably not doing great unless you're buying them at the bottom of the range here. But if you've let's just take this breakout. If you think, oh, it's about to make new highs, oh, it's about to make new highs, oh, it's about to make new highs, oh, it's about to make. Well, now you've taken 5 or 6 shots, and you're not thrilled, and you've kind of chewed into some of your gains if you were long for gold on the way up here. I think probably before the end of the year, we're going to see gold make a move to 4,000. I don't know when you're going to produce this interview, but time stamping this August 20th, 2025. John Netto, for all of his words and wizardry, thinks that gold's going to 4,000. If someone tunes in and it's back at 2,500, whenever you air this interview, well, then I'm not going to look very smart. Everything I just said will be undone.
That brings into the fact that, and you can stop sharing your screen here for a moment, unless you have more to review on this.
Nah, this is fine. This is fine.
You just brought up something that was very important too, and you called your shot, right? And but you
Yeah.
also said, it could go down a year from now, 2 years, but you think it's going to go higher. Can you talk about real quick, because people who are listening to this interview right now, they know you're successful, they know you've done this for many years, decades, right? 25 plus years,
Yeah.
and yet you still can be wrong. Could you just highlight the importance of uncertainty when it comes to this game called trading, and
Let
especially
me
for the new guys out there who are getting started?
let me just correct you on one thing, and this is a bit of a joke, okay? And that
Sure.
is, you said I could be
Yeah,
wrong.
yeah.
Let me be clear about this. I can be profoundly wrong, okay? Not just wrong, like embarrassingly wrong, okay? Like unmistakably wrong, like ouch that hurt wrong, okay? And that's never going to end because it's all a game of probabilities and mathematics, not ego. Okay. And
Yep.
for as good as I can be at identifying a qualitative macro narrative and building a great structure, and I mean, I can build a great structure around a trade. But guess what? The best thing I may end up doing is after this well conceived, well executed trade happens, it's just getting out early when for everything I thought was going to happen and all these articulate reasons, etc. When it begins to become undone, I see that I'm not attached to that result. I'm like, I'm getting out. And instead of losing, make up a number, instead of losing $10,000 or $100,000, all right, instead of losing $100, let's keep it simple, okay? I only lose 30 or 35 or 40 because I understood fundamentally what was happening with that trade, all right? And I keep
Hmm.
60% of that one risk unit. And it's the global macro edge is maximizing return per unit of risk. And part of maximizing return per unit of risk is losing less when you're wrong. Okay? It's not only losing
Yep.
less, but losing less when you're wrong. Now, sometimes you're going to lose everything when you're wrong. That's just what it is. There are liquidity considerations. There are all sorts of other things out there. But by monitoring it, by being protean, by being adaptable, by being flexible, if you can see a fundamental turning of that tide, okay, this isn't right, okay, or the Fed comes out with a surprise rate hike and you happen to be in a position where you can do something about it, okay, no ego, man, no ego,
Hmm.
just tee it up again.
Was that easy for you? Like to have no ego because you've been doing this for a long time. Like in the beginning, was that easy for you, or is that
You
something
know,
you challenged with?
here's the thing, like if I can say one thing, like for as frustrated as I was in 2000 and '02 and a couple other hiccups in '09, I mean, that wasn't, but even when I lost, as documented in the Gold Macro Edge in 2015, I took a drawdown. Part of the documented thing, late 2015 was with profits, 2017 with profits. Um, I have been very good at cutting losses, even on big loss days, which you would look at that and say, how are you good at managing risk if you lost that much? Well, because it was profits I gave back and I was very aggressive and I still got out. And I've had a couple of like hiccups along the way where I got out. I didn't sit and negotiate. I didn't equivocate. I got out. All right.
Hmm.
And yeah, it sucked. And yeah, I didn't sleep for 4 days. And yeah, you know, I like had this stupor hanging over me for days, like what just happened. Okay. And it sucked. But I still got out because that Marine
Hmm.
Corps training, that Marine Corps discipline, all right, when you're under fire and it's like, okay, this is the right thing to do, um, that was from day one.
Hmm.
And I'm not saying I haven't
Well,
taken some painful losses, but from day one, I have never blown up in my career. I've never blown up. All right. I mean, taking accounting blew it up. Never. I've taken some hits, but I've never blown up.
yep.
All right. And
And
that's,
that
yeah.
and that's because the idea of taking smarter risk plays. Could you
Yeah.
highlight that a little bit more for the newer trader?
Yeah, no, that's been an evolution. That was not a conception. That's an evolution.
Oh, okay.
It's the concept of knowing you can't blow up, but smarter risk trades are, listen, it's about maximizing return per unit of risk. It's about that's conclusory. But let's go into a real example. It's about when you understand the gold is part of a narrative, okay, that is shifting, and you take a defined bet, and everybody says, well, I know I want to make 20% this year instead of 10%. Well, if you want to make 20% instead of 10%, then focus more on finding markets that are in the middle of regime shifts where you can actually pay $10 for a gold option and make 50 on it instead of just like invest money in the index market broadly and just know that everything about your portfolio is going to increase in risk. Structure trades so that instead of owning gold at 3,200, you actually just buy the gold options for 2 days. If that's what the
Hmm.
environment says. There's other times where actually just owning the outright makes more sense than owning the options. I want to be clear. There's nothing so
Hmm.
austere and draconian that you're going to simply do this all the time. This requires adaptability. Optimal trade structure requires adaptability, requires expertise, requires knowledge, requires market fluency.
Hmm. Look, John, I know so many people are going to have so many more questions that I'm not asking. So I know I want to give you an opportunity to at least let people know where they can find
Sure,
find out more about you, like your books that you mentioned. Before
sure.
I do that, though, two more questions I really want to dive deep on with you, and that is
Dos
number
más.
one.
Dos más, Alejandro. Dos más.
That's right, dos más, por favor, gracias. And that is the first one is when it comes to emotions,
Mm-hmm.
because there's a huge thing out there like traders who claim they're failing because of only their emotions. Any advice for those traders who are like just they're always wrecking themselves because of their own emotions? Like maybe they get in a trade and then that trader who's like, man, every time I take a trade, John, I end up being right, but I never. am able to take advantage of the rightness. I just take a loss for no reason. Like,
Yeah.
any advice for those people?
Listen, for those people that think that, um, read Denise Scholl's book. Denise Scholl, she wrote Chapter 19 of the Global Macro Edge. She wrote a book called Market Mind Games in 2012, and it really goes into some phenomenal inner work on that. And then let me say, and this is, I mean, I've been in law school the last 3 years. I just took the Nevada bar exam, and I'm going to be an attorney soon. Let me just say this, okay, or presumptively, let's hope, fingers crossed, when I get the bar results back. Um,
I'll hire you once you get it.
yeah, there you go. If you want to be well represented, yeah, I'm not offering legal services. I'm not licensed. Let me just disclaimer that right now, so I don't get an ethics violation here. Listen, as a trading coach, not as an attorney, okay, as a trading coach, all right. If you want to really know if it's your emotions that are doing you in, email me, okay, because I'll give you some real tough love. If you've seen me here talk with Alex so far, you want some real adult convo. You want some real adult in the room conversation. Email me. Let me look at your trading record. Let me look at what you're doing. Okay, and for a fee, all right, I will give you my honest to goodness 25 years of experience of what I think you're actually doing and how you can improve that. Okay, because to some degree, yeah, your emotions can be sabotaging you, but if your system is substantively not viable to begin with, your emotions are actually, and your blowups are probably just saving you time. And they're getting you to the finish line even faster than what you would normally get because you don't have an edge to begin with. Okay.
Yeah.
Now, for people that do have an edge, I got some tricks and some bona fide methodologies that can help you. All right. Get over the hurdle, things that I've used, things that I've done, and a way to hold you accountable. Okay. But there are mechanisms out there to help people who believe. Because the first thing you want to do is if you believe that this is your problem, but actually you got three other problems, then you're not actually getting closer to the solution, are you? Because in order to have a solution, Alex, what's the first thing you need? You need to actually know what your problem is. Okay? And if you don't know all of your problems, at least all your material ones, that's going to be an impediment or a barrier to you progressing.
That's a good point. That's a good point. Could you share just one of those ideas that could be helpful for those if that is only the problem, just the emotional, and they have a viable system?
Yeah, no, the emotional is what's going on is you're ending up in your amygdala and you're going away from your prefrontal cortex. All right. So I wrote my capstone paper in law school on Section 230 liability, okay, and youth addiction from social media. 28-page capstone paper talking about there's a huge mass tort action going on. I'm going to get a little legal now for a second. In the Northern District, in U.S. District Court, Northern District, California, it's going to be heard in October 25. It implicates NetChoice. NetChoice is a conglomerate of internet companies like Facebook, I want to say X, Instagram, blah, 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 quite a few others, Snapchat or Snap. And there's obviously this huge rise in Texas was actually one of the big states as well that passed legislation to try and address this. We'll see if it passes constitutional muster. But the bottom line is we've seen a huge rise in social mental health issues, depression, anxiety, teen suicide. It's been going through the roof here. And states all over the country have been enacting legislation that is meant to at least alleviate that under the police powers of the state. So that we live in this bicameral system in the United States where we have federal power that regulates, and then we have the states are given police powers in domestic relations issues, and so health, etc., often fall, but can be preempted federally by fall into the state's jurisdiction. Okay, and so you have all these different states that have passed legislation to deal with this internet issue. The problem is there was the Decency Communications Act written in 1996 at the nascent stages of the internet because they wanted to protect internet companies, and it was well intentioned, okay? Because what you had here is like a message board like Yahoo, all right, that would have third parties come on and post stuff, and people would then try and sue Yahoo for what these third parties posted, and that was chilling internet growth and development. And so Section 230 is part of what's called the Decency and Communications Act, all right? And that basically provided indemnification or protection to social media companies, assuming that what they were putting out there wasn't their own, all right? And so you'll hear shortly termed Section 230 liability or the Section 230 indemnification shield, which protects social media companies from these things. Here's where I'm going with this, all right? And that is that from a mental standpoint, all right, your amygdala, all right, which is what often is not developed in adolescence, which is why they're so vulnerable to the social media algorithms out there, still can be your own saboteur because you're moving away from your prefrontal cortex. Your prefrontal cortex is the part of the brain that performs the analysis, that performs the reason, that has logic. Okay, and at least ostensibly, we're all supposed to be trading from logic and intuition. And I mentioned earlier in the broadcast that intuition is the manifestation of the byproduct of the analysis performed from your subconscious. All right, and so
Yep. I
that
love that,
analysis.
by the way. I
Yeah,
love that.
thank you. I've had to get used to saying it. And so the bottom line is, if emotionally you are living in your amygdala, okay, you're going through a similar issue that adolescents face, and why they are so vulnerable to this social media epidemic that's out there. Okay, and which is why I spent literally my spring semester reading through 2,000 pages of case law and God knows 600 motions and everything else and science articles, etc., to write my capstone paper from the Boyd School of Law. Yeah, so don't be surprised if I'm doing litigation that implicates social media once I get my license as an attorney.
No, I wouldn't be. But so, what is the advice then? The quick tip, or if it is their emotions that are
Yeah,
interrupting their trading, they have a viable system, right? What is
right.
like
Well,
that one
if
idea?
their emotions are doing it, it's probably the amygdala. And I mean, what is that? And so they need to understand is that like they go on tilt, to coin a poker phrase, okay? Because I was a professional poker player 15 years ago. Oh, by the way, and as a poker player, you don't want to go on tilt, okay? And yeah, you can Google John Netto poker player. It'll show you my card player earnings. I was a cash game no limit
You're
player here in
insane.
Vegas. You know, that was like oh 03, oh 04, oh 05, a little bit of oh 06, but then trading
We're
once the
going on a
VIX started
tangent
ticking up
here.
again. Yeah, that's
Yeah,
another interview. Okay,
yeah, yeah.
but yeah, I've very like paltry. I have like $15,000 of career earnings as listed in Card Player magazine for John Netto.
Well, you
So
mentioned earlier though, like
yeah,
there's several things that someone can do if they definitely have a viable system, right?
sure,
If the main issue is just their own personal emotions,
yeah.
like you mentioned, there's
Mhm.
multiple things they can do. I'm just asking, what is one idea just to give the viewer that they could maybe look into to help them improve on that?
Yeah, journaling's a huge one. Journaling, accountability, um, self action, self awareness, methods like that. Asking themselves a question, trying to step out of the instant, and the awareness. So let me just say this: the first thing is, if you know you're in your amygdala, you just stop. Because you're no
Mm,
longer engaged in the prefrontal cortex. Well, let me just go straight to number one. You just stop. I'm really
mm,
upset right now. Well, then you're likely, at least to a large degree, not in your prefrontal cortex. So stop.
yep, yep. Because you
If
know
you're
what?
now in your amygdala, it's fight, flight, or freeze. Fight, flight, or freeze. And if
Yep.
you're in fight, flight, or freeze, you ain't supposed to trade that way. You're not trading that way.
Mm. That's what they say. And I've experienced this. I don't know if you have, but like, something happened in my personal life and then I
Yeah,
trade and like it happened
yeah.
that morning before the open, and then I trade and that's not a good day for me.
I mean, but let's not also be retroactive in this, or let's not be like hindsight in this. Listen, life happens, and the awareness of those events. And so I'm not suggesting that we should all live these sterile lives. And if you wake up 3 minutes late, you shouldn't trade for the day. Or if, you know, something's bothering you, you shouldn't trade for the day. What I am saying though is that by journaling and recognizing this, that awareness of that can help you contextualize it and then ask yourself how much this is influencing me. And with time,
Mm,
with discipline, with training, with support, you can have an honest conversation about to what degree that's actually impacting you. And that's what I would say.
mm.
Um,
I like it.
is it, are the tools. There's not just hit this button and now you go from being on tilt to being like in this perfect. No, it takes hours for you to come down off your amygdala. It takes hours. It's I mean, just go and read any kind of neuroscience. Like this, it's an hours or even longer to come out of your amygdala once you're fully there.
Mm.
Once you're in fight, flight, or freeze.
I appreciate you sharing that. And the last thing I want to ask you before we start to wrap this up is if there's one piece of advice you can give just new traders out there
Yeah.
who are ready to start this journey, what advice would you give them?
Find your niche. find your specialization, and then leverage that specialization across relationships to get better. Become known as the guy that knows when to trade from 9 to noon. And now you become a value proposition to every other trader that actually can provide value. That I'm going to want to have you in my ecosystem. So I talked earlier about, like, in other words, you having another opinion on the S&P doesn't really help me. It could, but it's unlikely. But you having an opinion on the on Microsoft earnings, and all you do is follow Microsoft earnings, or all you do is follow the big four earnings, and this is what you live and die with, okay? And you trade those earnings, and you know those earnings inside and out. Well, now all of a sudden, I'm going to call you 4 times a quarter because I want to hear what your thoughts are, and I want to hear what's going on and what I need to look for. And now, because I'm reaching out to you, I'm going to share with you what I'm up to because you're giving me proprietary value, okay? And then I'm going to give you back value. So instead of being a jack of all trades, find something that's natural to you that you're interested in, really get good at that, know that, and then leverage that from other top traders to become indispensable. And that's how you become indispensable.
I love it, man. I love it, John. So where can people learn more about you?
Sure. TheProteanTrader.com, the PROTEAN trader, TRADER.com. You can go to follow me on Twitter at John Netto because I'm old school Twitter account. I got like 18-year-old Twitter account. Message me there. Reach out, buy my book on Amazon, The Global Macro Edge, keeping it real. Like, just, you've heard me talk. I mean, it is what it is. You can't help but be impressed. Joking, but not really.
Hey, so I'm not gonna lie. If you're not impressed with someone who go to the Marines, accomplished so much, who didn't even have a good in terms of smart education right in the beginning, and then all of a sudden just accomplish all this, now get past, hopefully, knock on wood, pass the bar exam, successful at trading, doing all of these things, and poker player, dude, that's insane, man. It almost makes it intimidating. I'm almost scared that people are gonna listen to this and be like, I can't trade if I can't accomplish all this stuff like this guy. You know, like, you got to be a genius. But I don't think that's the case.
No, you don't. No, you don't. You just got to be consistent.
Yeah.
You got to find your niche, like we just said, and provide value. And just having the discipline to not blow up. Let me say this: thinking that someone, and I'm not saying I am or not, but thinking that someone's intellectual capacity or intellectual quotient is indicative of their trading success, you would be sadly mistaken. Okay, it's the people that can follow a system, have discipline, okay, execute, see an edge, and then when they're wrong, get out. Because people who have high EQ, guess what? Also, they have a high thing of the high ego, high attachment.
Yep.
I can't be wrong. Okay. Ask all these Ivy League portfolio managers that just gotten destroyed. Okay. Like when the market goes through a drawdown, they can't adapt. Not all of them. There's some can, obviously, but it's their egos. Okay. And when your ego gets hit, you go straight to your amygdala. Because guess what you want? You want to chase. You want that back. You want that loss. You want to chase that loss. Okay. And that's primal. All right. And no matter what your IQ is, once your primal kicks in, okay, you're now living in your amygdala. So your prefrontal cortex doesn't matter how smart you are because you're living in your amygdala. You're living in fight, flight, or freeze.
You're a caveman right now, buddy.
Like, you're a caveman. So that's the neutralizer. So yes, you can absolutely do it. Stay out of your amygdala because you and your prefrontal cortex, you're a hell of a lot smarter than me and my amygdala. I can tell you that. Okay.
Yep. I appreciate it, John. Look, man, thank you so much for being here today, brother. It was such a great time. And look, I know I'm going to bring you back in the future because it's just been a great time, man. So thanks again for being here, man.
Appreciate you, Alex. All the best to you and your family. Much love, man. Go Cowboys.
Thank you for finishing today's episode. If you're watching on YouTube, please leave a comment below of one of the takeaways that you are going to implement into your own trading. And if you happen to be listening on a podcast platform, go ahead and leave us a review and let us know what you enjoy about today's episode, because that does go a long way in helping us continue to grow. Again, thank you from the bottom of my heart, and I look forward to seeing you on the next episode.